Know what you own and know why you own it. Peter Lynch.
Are you ready to make the most of the only life you have? To make smart money choices focused on achieving what you care about most? Here to help you balance living well today without sacrificing your tomorrow is the Retirement Answer Man, Roger Whitney.
From my heart and from my hand, why don't people understand my intentions? Plastic tubes and pots and pans, bits and pieces, and magic from my hand. What are we making? Yeah, we're making some weird science. We started this investing series off with that song, Weird Science by Oingo Boingo, one of my favorite bands from the 80s. The reason we did is because there is a lot of weird science going on when it comes to investment management. A ton. And if we're going to invest successfully for retirement, we need to have some sound science to start to build investment portfolios. So we, I think, built a pretty good foundation on sound science over the last 6 weeks. There's a lot more to do, but we're going to finish this series to give us the basics, and we'll come back and revisit this. So last week we talked about choosing active investment managers for the flexible portfolio. Now we're going to talk about how do you go about thinking about the fixed allocation to more passive or index-based portfolios. So we can't do that until after this disclaimer, though. Time for that all-important disclaimer. And, this can be annoying because I got to do it every time. But you know what? It's super important because we're going to talk about indexes today. Well, you can't invest in an index. It's just a statistical model. We're going to talk about some investments. Well, you know what? Different kinds of investments have different types of risk. They all may not be appropriate for you. Where it comes to performance, they all perform differently and have different risk levels. And there's no guarantee of future results. So before you make any decisions, talk to your legal advisor, your tax advisor, or your financial advisor, because that's just common sense. Now, let's get into this index bugaboo in the Hot Topic segment. Well, in the news today, it appears that indexing or index-based investments are taking over the world. So what do I mean by that? If you Google the top largest mutual funds, 2 of them replicate the S&P 500. 5 of the top 11 exchange-traded funds replicate the S&P 500. If you look at the top 25 mutual funds, over half of them are index-based, many with the S&P 500. The top 2 funds alone, which replicate the S&P 500, have over $400 billion in assets, and many of those strategies have seen the biggest inflows they've ever seen in history. It makes sense because the S&P 500, partly it feeds itself, has had amazing performance. Since February of 2009, up until April of 17, it's had a total return of 254%. So success breeds success in that sense. So the question is the S&P 500 based on sound science? And we'll explore that a little bit in the practical planning segment when we look at implementing the passive part of it. But I find this very interesting. I find it interesting every time because indexing is just, the deal is done. The jury is back in. The verdict has been said. We looked at how poorly active managers do last week. Indexing is really the only way to invest. It feels that way. And if you look at flows into mutual funds and other vehicles, it appears that way. 30% of U.S. equity trading is done by index ETFs. Pretty dominant market, and you have this massive flow of money going there from 401ks and all these other automatic investment programs. The reason I find it a little funny is because this isn't my first rodeo in investing. And I remember in the mid-90s, and I started in 1990, I believe, 1991. See, that's how old I am. I'm not old, but I started in 1990, 91. And at that time, it was the beginning of the dot-com phase or the new economy. That's when internet was becoming a thing and telecommunication was becoming a thing. And by the late 90s, the jury was back in. The verdict was delivered that the S&P 500 index and other types of indexes were not getting it because it was a new economy. All the money was flowing Not all, but you know what I'm saying. Most of the money was flowing to the new economy stocks. Then that blew up. Then for a while it was international equities. That was where you needed to be, and it drastically outperformed the U.S. domestic indexes. It was annuities for a while because of the safety, and then it was hedge funds for a while, and we had the endowment theory that because there were some endowments that were having amazing returns, and so mutual funds became in fad. And then we had real estate. We had the real estate boom, or why would you ever invest in the markets when you can flip houses? And that blew up. And now we have the index boom, very much so the S&P 500 boom. Now, I'm not making judgment here. I'm just making observations. Index is a very efficient way of getting exposure to markets. I use them from time to time. The question is, for us, is it how we should implement the passive part of our portfolio? And I'm not saying it's not. I think it's something we just need to make sure, one, we know what we own and we know why we own it. So let's examine specifically the S&P 500 and how indexes are built in the practical planning segment. So here we are at the end of investing for retirement. Oh no, Nicole's going to be mad at me. She told me never to sing on the podcast again. Though this is the last installment of this iteration of investing for retirement. And we're going to end with talking about how do we choose vehicles or managers to invest the more passive or fixed portion of a portfolio. So let's review, what are we trying to accomplish in doing this? Why are we even trying to do this? So our goal or objective in this fixed allocation is to, number one, achieve broad diversification in the markets. Remember, we talked about diversification. You have two types of risk that we have to deal with when we're investing. We have specific risk, which are specific to a particular company or a particular sector or industry. One way to manage that risk is to diversify broadly so you can eliminate most or all of that specific risk by having this huge basket of investments in whatever asset class. And then you're left with market risk, just the risk of being in the markets and the ups and downs. So one of the objectives in this fixed allocation is just to get in the markets in a very diversified way that is targeting an asset allocation that has return risk characteristics that we are comfortable with based on what we know. So that's the objective. And index-based investing tends to be the thing we feel can achieve that. So let's talk about what an index is. So we'll talk about the S&P 500 in a moment, but let's talk about what an index is. In fact, let's just use the S&P 500 as a proxy in terms of structure. So an index is not something you can invest in directly. It is a mathematical model designed by a firm, like in this case, it's the S&P Standard & Poor's Company. They have an index. They have lots of different indexes, but the most popular is the S&P 500, and it's meant to represent a broad swath of the U.S. equity markets. And so it's a mathematical model, and they reconstitute it based on their methodology every year. And then what you have is you have indexes, index-based investment products put together by investment firms that try to mimic that particular mathematical index. So you're never actually investing in the index. You're using something that's trying to mimic a mathematical model. And the way they do that is they look at how the index, Standard & Poor's 500, says, okay, this is what it should be. These are what the components should be, and this is how it should be allocated. And then the goal of the index-based investment is to have as small of tracking error to the mathematical model as possible. So it's prioritizing low tracking error over higher expected returns. So it's not trying to actively do anything other than be as close as it can to that mathematical model. So let's talk about some of the advantages and potential disadvantages to that approach of following a mathematical model. Well, one of the biggest advantages to investing in something that's trying to track a model like the S&P 500 index is that because it's what's called dumb beta, it's just not thinking, it's just trying to replicate what the model says. There's not a lot of thinking going on other than trying to keep the tracking error as small as possible. So it doesn't have to cost very much. It can cost almost nothing in almost real terms. So passive investing using index-based investments can be super cheap. And they don't trade around it in any substantial fashion. So the turnover ratio, remember the amount of trading that goes on the portfolio, can be very low, which reduce trading costs and it can reduce tax impacts and things like that. And if we recall from the study that we looked at from Dimensional last week, investment expense and turnover were two of the big reasons that almost all active managers don't do well relative to the benchmark, which makes sense. So in some ways, it's not necessarily that index model is better. It just can be so much more efficient in the cost and in the turnover that it has an advantage that way. And that's a great thing. Now, what are some of the nuances that a lot of us may not understand about indexes, and some would say are disadvantages of indexes? They could be advantages at periods of time like now as well, that we just need to make sure we're aware of if we're trying to hit the standard of know what we own and know why we own it. Well, the first one is, how is the index constituted? How is it created? Well, when most indexes, not all of them, but the majority of them are what are called capitalization weighted, which means the larger the size of the company in an index, the more influence it has over the index. So if there are 500 equities in the S&P 500 index, they're all not counted equally. The larger companies have a bigger impact on the returns of the index. And as companies get larger, their percentage relative to the other companies in the index get larger too. So let me give you an example. Currently, in the S&P 500 index, the largest company is Apple Computer. So Apple represents about 3.6% of the S&P 500. If you take the top 5 stocks in the S&P 500, which are going to be Apple, Microsoft, Amazon, Johnson & Johnson, and Facebook, those 5 companies represent about 11.5% of the entire index in 5 companies. So if you look out a little farther, if you look at the top 10 holdings of the S&P 500, they represent 19% of the S&P 500 index. The top 20 companies represent about 29% of the S&P 500 indexes. And if you go out to the top 30 companies, they represent 37% of the index. So you can see the impact that the largest companies have on the performance of the index. And that's why in periods of time when these super large companies are performing really well and growing, they help the index in terms of performance, and plus they gain influence over the index over and above the other constituents in the portfolio. So in effect, with a normal index like the S&P 500, what you're doing when you buy the S&P 500 index, you're buying a much more concentrated portfolio than you may realize, because there are maybe 500 companies in there, but the vast majority of the index return and risk is focused on a much smaller portion of the portfolio. And then when you have so much money flowing into investments based off of index like the S&P 500, it feeds on itself, because as more money comes into the index-based investment, they're not thinking. So all they're doing is buying more of what the index has, which is concentrated in the highest portion of the index, which means they get bigger, which means they have more influence. And you can see the snowball effect that can happen as a result. So you become a little bit of a momentum investor when you're investing in an index that is capitalization based. Now that can be great when those huge companies are doing extremely well, but you could also have the opposite effect. And we've never seen index investing like we've seen before. So nobody really knows what implications are to that when people move money out of the indexes if we have a correction and people get scared and we see money flows, which generally happens. And it also means that the sectors that are out of favor in the index, the ones that are underperforming right now for various reasons, you own the least amount of them until they go through a cycle upturn, and then you can start buying them after they've really become big again. And so that's one risk you have when investing in a fund or in a investment that's based off of a mathematical index. That said, it's still an extremely efficient way from a cost and a turnover perspective to invest in the markets. Another disadvantage is that they are very clumsy in how they reconstitute the portfolio. So what do I mean by reconstitute the portfolio? So every year, Standard & Poor's comes out with what the portfolio should look like. So it's a passive quote-unquote index, but over time, what makes up that index changes because S&P and its model is trying to mimic what's important in the economy. So it'll remove companies from the index and put companies into the index and say what percentage everything should be. And then all of the investment-based products will trade their portfolios in line with whatever this new constitution should be. So S&P 500 comes out with that annually, and then pretty much blindly, anything based off of that index will trade their portfolio like that. And it will happen in a very small period of time. So you end up having this herd effect of everybody trying to do the same thing at the same time. Sell the companies that are out of the index, buy the companies that are in the index, and change their allocation. So you have very inefficient trading, which many studies have shown really affect the stocks, meaning that you're not getting a lot of great prices. No different than if you were to go to the supermarket, everybody's trying to buy something at once, the price is probably going to go up because of that high demand. So that it's very clumsily implemented, and that can be a disadvantage as well. The last disadvantage, which also can be an advantage, is that generally you have very retail type investors, people like you and I. And history has shown that, especially in things that are fatty, and I'm not saying index is fatty, but it reminds me of the other things where everybody's buying it. What ends up happening is that's not generally patient money. When something is done extremely well over a long period of time, it's not very patient money. And as soon as it stops doing well, you see people head for the exits to go to the new thing. And we've seen that over and over again when researchers when they track flows to different types of asset classes. So that worries me a little bit. And it's something to consider. I'm not saying that it's not something you do, but I'm saying it's something to consider when you're implementing this more passive approach, is to be thoughtful of the things that you're putting in there. Because the main advantage that indexing has, index-based investing, is that it's very low cost and it's very low turnover, which really helps in the overall performance. So are there other options out there? There are. There are firms that look at the drivers of performance over history and that use very in-depth academic research to say, okay, where are the drivers of return over a very long period of time? As an example, over time, smaller companies, if we're just talking about equities, smaller equities have a premium over large equities or companies in terms of performance that has sustained over a very long period of time. There's a value premium, meaning companies that are considered value companies, which are more value-based rather than growth companies, meaning that they're using the Benjamin Graham type of methodology of looking at companies that are undervalued. The companies that are more in the value tint historically have performed better than just simply large companies in general. And then companies that have higher profitability and a history of higher profitability have generally had a performance premium over just the entire market. And there are firms out there that try to exploit these that are in a low cost, in a low turnover environment, which may be a smarter way to invest this fixed portion. I guess my point here is if we're going to know what we own and know why we own it, it's important that you understand that if we're going to implement the fixed portion with something that's replicating indexes, understand what those indexes are and how they might act and how they're constituted so you know what you're getting. So as we sum this up, let's focus on what at the end of the day are we trying to do when we're building a portfolio to help us. Obviously, we're trying to get something that's helping us within the context of what we need to achieve the life that we want. We weren't able to get into that part of it in depth, and we're going to do that in another series, but I wanted to build this basic investment foundation first. But that's obviously the most important objective. It's not relative performance, but achieving the life that we want. But when it comes to building a portfolio, we want to focus on the things that we can control, which is diversifying broadly to try to manage risk best we can, to make sure we're broadly diversified, to reduce expenses and reduce turnover, because history has shown us that those two are key factors in investment performance, and to try to minimize the tax impact on the overall portfolio to keep as much money as we can from an investing standpoint. So if we're going to know what we own and why we own it, I think we need to focus on these types of things that we can control so we can build that portfolio. Now, I'm going to be answering a lot of questions that have come in from listeners about this entire series. So if you have a question or a comment related to this topic, go to rogerwhitney.com and go to either the contact page or ask a question and input it in there, and I'll answer it on the show. And we're definitely going to revisit this topic in the future. But when you're looking at implementing the fixed portion of your portfolio, I think these are some of the things that you need to consider as you build that out.
On your marks, get set.
Hey, welcome to the Smart Sprint segment. It's hard to say fast. It really is. Anyway, this is the segment where we set a 7-day goal to take a little baby step to managing our assets more prudently and creating a great retirement. So this is going to be the last investment-based sprint for a while. But what I would like you to do is I would like you to look at the more passive investments that you have. Maybe you own something that replicates the S&P 500 or some other index. Go pull up the fact sheet, either from a service like Morningstar or the provider, and look at their portfolio and get an understanding of how concentrated it may be. And look at that not just on the individual investment realm, but look at it from all of the different types of more passive investments to see how concentrated you are and to have a better understanding of what you own so you can make a better decision as to why you own it. Hey, welcome to the Happy Lab, where we noodle on how to live a happier life. Well, last week, I had something unexpected happen. I was working and I got a text on my phone. It was from a buddy. And he said, "Hey, Roger, congratulations." I'm like, "Dude, what are you talking about?" He says, "You were just selected by Investopedia as one of the 100 most influential advisors in the country." I'm like, "Oh, that's sort of cool." And he sent me the link and I pulled it up. Had no clue that they even did something like that. Now, I don't really get excited about stuff like that. I get excited when I get emails from you with questions or emails from you with comments, or when I'm working with a client. I get excited about that stuff. I generally don't get starstruck or get into lists and things like that. But you know what? It was weird. That day I was working at home and I was like, that is sort of cool. 100 most influential. And it's not one of those things you buy. I never applied for it. I don't even know what it is. I don't know how they even knew to look at me. So I actually got a kick out of that. And I think it had to do with, this is episode 178, I believe. So it's 178 weeks, missing only 1 week. So that's over 3 years of getting a chance to talk with you and share your stories, share stories from other people, and answer questions. That's a lot of work, and it's a lot of fun. And so I took a little bit of time to be thankful for the acknowledgement of it, because it makes it feel like it's all worthwhile. Really, it's the emails that make it worthwhile. But I guess the lesson there is take some time to appreciate someone else. And when someone's appreciating you, take it in and actually acknowledge it. and don't downplay it, because if you're like me, you probably downplayed a little bit, and you most likely you've earned it. So I think that's a good way, and that'll make you happy. Well, I hope you've enjoyed this Investing for Retirement series. It's the first of many series, and we'll definitely come back to the subject. Now, this last week, I launched something that I'm super excited about. It took so long to develop, and I hope you're going to enjoy it. It's called the 5-Minute Retirement Makeover, where we dive into how current planning is done and teach you in 3 fairly quick videos how to create a more agile process to manage your life in retirement. So if you'd like to get this 3-part video series on creating a retirement makeover, go to 5minuteretirementmakeover.com, and I would love to hear what you think about it. Until next week, this is Roger Whitney, the Retirement Answer Man.
We appreciate you joining us today for this episode of Retirement Answer Man. Be sure to visit rogerwhitney.com/answers to access the Retirement Answer Library with over 30 checklists to help you make the most of the only life you have. Remember, you have more power than you realize to create an amazing life starting today with Retirement Answer Man. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future results. All indices are unmanaged and may not be invested into directly. Have a wonderful day.